Saturday, February 22nd, 2020, MONERO 64, home of alternative economics and contrarian views. Today I want to look at the technical picture for precious metals, gold and silver, and also some mining stocks in the silver space that I think could do well. It's not advice, of course, for any of you to go out there and buy it. It's just my opinion. I also want to look at a short presentation I've prepared in the last few days. And the reason why I've done this is just to show you that the only reason I emphasize gold and silver is that gold and silver are very good insurance policies for monetary mayhem, currency debasement. They serve as a base for all your other investments. And of course, their money, and it's up to you to balance your savings as you wish. I'm going to talk about this presentation today and give you my opinion and what I'm doing. So before I go on to the technical picture for precious metals, just wanted to say that I've got a promotion right now in the MONERO 64 Teespring store running until March 15th. The promo code there is Winter 2020. You get 20% off all the merchandise there. One of them, of course, is one of my End of Fed mugs. I've got other End of Fed mugs as well, Billy mugs, t-shirts, stickers. So yeah, 20% off in that Teespring store. So let's look at the technical picture for precious metals. I'm going to start out with gold and a long-term chart. Why a long-term chart? Because I think it's very important to look at the bigger picture to see where we are. Day to day, week to week, gold can be very volatile, of course. We had a great end of the week, of course. The month has been very good as well, as you're going to see in this chart. So this is a monthly chart going back to January 2010 in gold. And you can see there we got the top in 2011 just above 1920 and the bottom in December of 2015 at 1045. And I've spoken about this level many times. It's the 61.8 retracement of that move from the all-time high to the bottom in December of 2015. A lot of you, of course, don't buy into technical analysis. I do. I think it's not perfect, but it helps. So 61.8%, of course, is the golden mean, the Fibonacci golden mean. It's a proportion that happens not only in markets, but happens in nature. It's everywhere. It's even used for architecture and other fields. So the other point about this level, which is around 1585, 1586, is that if you look at the top of gold in 2011, it came off, of course, but was pretty much holding between 1550 and 1800 until I would say it was April 2013 when it really dropped and then broke through that 1550 support. You can see that 1600 was kind of support as well. So that 1586 level is right in the middle of that 1550, 1600. So it was going to be a strong barrier, or it was supposed to be a strong barrier. But as you can see, it wasn't, because in a couple of months, we've been able to break through that level. And it's interesting to see that the January high there was right around that level. Yes, gold has broken out quite strongly through that 1610 level that we saw early in January. We can pull back, but I expect that Fibonacci level there to be a very good support in the short term. Longer term, as you can see from the chart, there isn't really that much resistance up until the all-time high. There is that other Fibonacci retracement level there that is not as important, 1733, 78.6. And just before I go look at silver, look at how that 38.2 retracement was really important. That happened to be just around that 1375 level. Let's look at silver. First, I'm going to show you a monthly chart, again, going back to January 2010. And why did I write big opportunity for silver prices? Well, because if you look at what gold has done, we should really be, I would say, around $30 in silver, maybe more, and we're still below 20. So I think it's a big opportunity here. We're right near the bottom of the range of the last 20 years or so. I think it's a screaming buy, silver. Yes, we need to be patient. And why has silver, in my opinion, underperformed gold? Well, because right now gold is acting more as a currency, as money, and silver, of course, is a hybrid between money and industrial commodity. So I think that's what's hurting silver, but I still think silver is ready to follow gold. So let's quickly look at a weekly chart of silver, more shorter term chart. You can see that the trend is higher, in my opinion. What we are witnessing now is a consolidation, and looks like we're ready to break out, and we could easily go test that 21 level. That's going to be a very key level, and it's not going to be easy. It's going to be they're going to fight tooth and nail, I think, the bullion banks or the shorts. But eventually silver will pop through that 21, and once it pops through 21, I think it's going to be very hard to keep it down. So I said I wanted to look at some silver mining shares. I have a couple that I've had before. Right now I don't have them, but they're good proxies for silver. They're kind of leveraged on silver. First one is Hecla Mining. I think it's one of the oldest listed companies on the New York Stock Exchange. You can see here, this is going back quite a way here, 2009. You can see the last time that silver went to near $50. That stock went up to almost $12. Right now, we're still under $4. So that's an interesting stock to have as a proxy for silver. So it's a leveraged silver play, I would say, Hecla Mining. And I think they've also diversified into gold right now. So the mining company is not just silver, they're also into gold. The chart right now looks like it's consolidating. The trend is up. And it's just a consolidation. Almost looks like a bull flag. Pan American Silver, that's a very good proxy as well. That's actually doing better than Hecla, I would say. And yeah, it's really breaking out. Maybe this is a signal that silver is going to follow. So looks like they had a flag as well. And last week we broke out of that bull flag formation. So I think they look like interesting plays. I'm not advising people to buy it, but if you are looking at mining shares in the silver space, that's what I personally would look at. Of course, there's other ones as well that you can look at. Now I want to look at the Dow Gold Ratio, because that's very important. I know the stock market has been going up a lot since September last year, when the Federal Reserve started pumping money into its balance sheet again. And I don't care what they call it, their balance sheet is increasing. And the stock market has gone up in terms of Federal Reserve notes. But if you look at the Dow Gold Ratio, it gives you a better idea what the stock market is doing in terms of real money. So I'll first show you a longer term chart. You can see that that's how many ounces of gold you need to buy a Dow. It was way overvalued back in 2000. We almost got up to 45. I think it was above 40, that ratio. And then in 2011, we got down to around 6.5 or so. And in my opinion, the rally we've had in that ratio, which means the Dow has been outperforming, has been a counter trend rally. With that, I'll show you a shorter term chart so you can see where we are exactly right now. You can see the low there in August of 2011 and the top in September of 2018. So that's the real top in the stock market, in my opinion, in terms of gold. And it looks to me like we're forming a head and shoulder top. It's not the best chart. I couldn't get another chart. We closed around 18 this past week, Dow Gold Ratio. So I'm almost over with the technicals, and then I'll go into the presentation I told you about. I just wanted to show you the Fed's balance sheet and the stock market. And why is that? Well, because if you look at the Fed's balance sheet here, when they started unwinding the balance sheet, that was in the beginning of 2018. You can see that the stock market, throughout the period where they were unwinding, was having a tough time really taking off. It had some ups and downs, some crashes, especially at the end of 2018. And then it went back up, and it was kind of crashing again there in September of 2019. Beginning or end of August, beginning of September, and then the troubles in the repo market started, and they decided to inject money into the system to again increase the size of the balance sheet. How do they increase their balance sheet? Well, they create credit entries out of thin air. They go into the market and they buy assets that they put onto their balance sheet. That's how they do it. So that credit entry they create through typing on their system out of thin air, that goes into the financial system as cash. So the financial companies, banks, brokers, hedge funds, they get that cash. They sell the securities to the Fed. They put it in the balance sheet. They get that cash and they go and buy stocks and everything else. And you can see here that in this other chart, it was right around the time when they started increasing their balance sheet that we saw a bottom in the stock market, and then the stock market started really rising. But an interesting thing here is that you can see the balance sheet kind of looks like it's topped right now. I know they're doing repos, and that doesn't really go into the balance sheet, the repo, because it's overnight, so it keeps getting off and on the balance sheet. So they're still doing that 60 billion in T-bills, but it looks like the balance sheet is kind of topping, maybe even coming off. Could it be that we're topping in the stock market? Will the Fed allow that to happen again, for their balance sheet to shrink and the stock market to have a tough time? I don't know. It's difficult to say, but I think it's really important to keep an eye on the balance sheet of the Fed. And you just have to Google St. Louis Fed balance sheet, and you get that chart. It's really easy, public information. I know a lot of Fed officials are trying to come out now and say that no, it's not the balance sheet that's causing the stock market to go up. Even though Dick Fisher, president of the Dallas Fed, 4 or 5 years ago, he was on CNBC saying that QE was just basically cocaine and heroin into the market to make the market go up. So, of course, at the time he'd left the Dallas Fed, so he's free to tell the truth. So let's finish now with this presentation. And the reason I'm doing this presentation, I decided to do it, is because, yes, I focus on gold and silver a lot, and I think they're very important. But some of you have different risk profiles. Some of you have a lot more wealth than others that view my videos or watch my videos. Some of you don't like taking risks. Some of you like to trade. So I'm just going to give you my opinion on what I think income speculation and safety is all about. So as you can see, this report is not financial advice. Consult your financial advisor or do your own homework before putting your savings at risk. So let's look at income. How can we generate income? That's really a question that's very important nowadays, seeing that the fixed income market has become the fixed confiscation market. Fixed income market, of course, is another name for the bond market in Europe. It is the fixed confiscation because rates are negative for so many bonds and other securities. So, of course, you can make a living or earn an income from your work. And I think that's the other thing people never think too much about. Investing in yourself is really important as well, in my opinion, or investing in your family, your children, your wife, even close relatives, investing in them, giving them an opportunity maybe to think of a business and start earning their own income. Don't just think, oh, let's put it in the stock market or in the bond market. So I think that's important. Of course, there are fixed income securities. Those are bonds. And some of you might be interested in bonds. And they have all kinds of risks. And there are some bonds that are less risky than others. Investment grade to junk. And the other risk from bonds is the time risk. So short-term bills are, of course, a less risky way of tying up your money for income. Of course, you're going to get a lower income, but you're not tied up for too long in case interest rates pop up or interest rates drop. Let's say interest rates pop up to 5% and you've got a 2-year note that only gives you 1.5. You're going to have to wait 2 years to reinvest that. But if you have a 3-month deposit, you can wait a few months and then put that money into a 5% yield investment, right? So that's why short-term bills are less risky. Their prices don't move as much as well. So there's all kinds of bonds that you can invest in. Am I saying you should put your money in these? No, I'm just giving you an idea of where to get income. You've got government bonds, corporate bonds, agencies. These are like mortgage-backed securities. Municipal bonds are the counties or state bonds. And preferred stock, which is a mixture between a stock and a bond. Those you get sometimes quarterly income on those. Their price moves are quite steady, but I don't think there's too many of them around. So these are interesting places where you could try to get an income. Dividend paying common stocks, blue chips to small caps. Of course, some are riskier than others. You can still get a dividend for quite a few common stocks. I personally view stocks as very speculative as well. I think bonds are not as speculative. Of course, real estate, you can buy to let, of course, or buy to rent, as you would say in the US. And there's all kinds of real estate properties, commercial, residential, agricultural, farming. And there's also securitized real estate, which is real estate investment trusts, or REITs or REITs. And I put here alternative properties. Maybe someone who's watching me here has a lot of money and can afford to buy ships or yachts or private jets. You can always charter those and make an income off them. And I think a lot of very wealthy people do probably. Yachts, of course, are kind of a money pit. But if you have a good chartering agency, who knows? So that's income. And the thing about income is the more income you try to get from all these kinds of investments, the riskier it's going to get. That's what you need to keep in mind. So Just because something has a high yield doesn't mean to see it's great. What it means, it's riskier. Just keep that in mind. Speculation. So here's another way to make an income, but it's not as safe, I would say. You've got derivatives trading, exchange traded, like on COMEX or CBOT, and over the counter. That's more for very wealthy individuals or institutions. They can call Goldman Sachs or an investment bank. So I would say for people like us, it would be exchange traded. You got the stock market. I think it's speculation. Of course, you can get some stocks that are quite safe. As I said earlier, you can get income dividend from them. But in general, a lot of stocks are very speculative. Hedge fund investments, that's for the wealthier people out there. Some hedge funds market themselves as being very safe, but I think they're quite risky and it's speculative. Leveraged real estate, what does that mean? Well, unlike buying one property to rent without too much mortgage on it, this is like when people borrow a lot of money or to buy properties, like they've got 10 properties and they've got 60% mortgages on all of them. That's leveraged real estate. I'm sure a lot of you are into that, and I'm just telling you what I think. Commodities trading, I guess that's part of the derivatives. Mining stocks that I talked about earlier, I think they're very speculative as well. Cryptocurrencies, even though Bitcoin is supposed to be the new digital gold, I still think they're very speculative. Private equity, that's for wealthier individuals. The other thing about private equity is that the liquidity, it's not like you buy a stock in the stock exchange and you can sell it whenever you want. It's not as liquid, private equity. Your money might be tied up for a long time before you see some payback. Precious stones, I think it's like diamonds and things like that. I think they're more speculative as well, and they're not as liquid. Art, antiques, and collectibles, I think, come under the same as speculation. You might not agree with me. That's the way I feel about those investments or speculation. So what do I regard as safety? Well, this is not in order of safety. I just put it on the list here. I'll tell you which one I think is safer. You probably know already. You've got fiat currency cash in the bank or outside the bank. I guess both of them are very risky. Outside the bank, you could be burgled in your home. In the bank, it's an unsecured loan to a bank. But it's still safer than all the other stuff I talked about before. And then you got gold and silver. Those are the ultimate cash. Don't forget, the word cash was the specie that you got in return for exchanging your banknote. If you took your banknote to the bank, they gave you cash. That was gold or silver. So I think those are the safest for me. Yes, you need to be careful, of course, where you keep them, where you store them. This is up to the individual. So we're almost getting to the end of the presentation. This is the reason why I think safety, for me at least, is more important. Even though it doesn't mean that I'm not speculating or trying to get some income from some of my savings at present. So why balance amongst income speculation and safety is paramount for me at present. Yes, balance as well is important. My balance is more leaning towards more safety at the moment, just to let you know. So one of the reasons is all the cumulative debt on central banks' balance sheet. It's just been rising astronomically since the great financial crisis. And that means that there's more money out of thin air out there supporting asset prices. They're not really real because all this money created by the central banks is out of thin air. They didn't do anything productive to conjure up those funds. Also, the ratio of debt to gross domestic product for key economies, as you can see, They're really high. They're, I think, on average. And historically, those debt levels are synonymous with instability and possible financial market troubles. Global debt with negative yield to maturity, that other one as well is very scary. All that means there's still a lot of money flowing around, and that bond prices are very overvalued, seeing that rates for some of them are negative. I think we're up to around 13 trillion right now. I think it got up to 17 trillion August last year, and now we're back up to around 13. It got back down to 11 at the end of last year, and now it's picking up again. NASDAQ 100 index, just looking at that chart from 1998 to the present makes me a little bit uncomfortable. It makes me think, is that really a bottom or a top? You decide. And then the Dow Gold Ratio as well. We got the 200-year chart and the shorter term chart. As I said, I think in general, common stocks are overvalued. I think the coming correction, I think, in the paper assets is going to drive that ratio a lot further down below that green line that you see there in the 200-year chart. I think we're going to test some pretty low levels, and all that means is that gold is going to outperform the Dow and paper assets. To finish off, just going to look at John Exter's pyramid. John Exter used to work as a banker from the 40s until the 60s. He worked for the New York Fed. He helped found the Sri Lanka, or Ceylon as it was called back then, central bank. He worked for major Wall Street banks, and he was a proponent of sound money. And this pyramid corresponds kind of with my views on income speculation and safety. You can see that right at the top of the pyramid there. He's got derivatives, unfunded government liabilities. Then you got non-monetary commodities, private business, real estate. And you see a lot of people, they think that gold is a commodity. They don't look at it as a monetary commodity, but in this pyramid it is, and that's a good thing. Corporate and municipal bonds, securitized debt, listed stocks. So you can see it's quite up that inverted pyramid. So not as risky as derivatives, of course, and commodities. And then you're getting closer to safety, government bonds, longer term bonds, T-bills, less than a year, as I said. And then you get the paper money, and then you get gold. And I would add silver to the bottom of the pyramid there as well with gold. So there you go. Don't limit yourself to just gold and silver. But gold and silver are very important in my opinion. What proportion you keep as a base for your savings is up to you. We are all different. Some of us are more into risk taking. Some of us are not. Some of us also need more income from investment. Some of us don't need as much income from investment because we earn an income from work or whatever we do or business. Hopefully you enjoyed this kind of presentation. It did go on a little bit, but it is the weekend. Let me know below in the description what you think. And if you enjoyed the video, make sure you hit the like button, share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great rest of the weekend. Take care. Bye.